Hello and welcome to this weekly market recap for the week ending May 16th, 2025. I'm Tom Boley, Chief Market Strategist here at EarningsBeats, and it is a pleasure to be with you all again this weekend. Pretty good, solid week last week. First, of course, I have to mention the new hat that I got. I was out at the PGA Championship with my fellow colleagues here at EarningsBeats on Thursday, and then I went back out on Friday and was able to see quite a bit of the tournament. Of course, the PGA Championship this year is being held at Quail Hollow Country Club in Charlotte. So I thought I would show a little love for golf and the PGA Championship this weekend. As far as the market goes, last week was really a good week. We got off to a good start. The U.S. and China had talks over last weekend. They agreed to reduce the tariffs for a 90-day pause so that they could continue talks. Market like that, kind of removing some of the uncertainty, continuing to remove some of the uncertainties out there. Inflation reports came in fairly tame. I think the core CPI annual rate came in the lowest it's been over the last 3 years. So again, I'm not quite sure what Fed Chief Powell and his Federal Reserve colleagues are looking at right now, but still not seeing any jump in the CPI. And I mean, honestly, you had a full month of tariffs in April. I would have thought that you would, if they were going to get passed on to the consumer, they would have been passed on, or at least would have been felt at the producer level. But we really didn't see much in the way of inflation. And I think that helped to bolster the market as well. Again, just seemed to be, eliminating one uncertainty after another. And that's allowed the stock market, after dropping from 61.44, I'm talking about the S&P 500, dropping from 61.44 down to 48.35. That was more than 1,300 points. We have now recovered 1,100 of those points back. So very, very strong rally. Some saying bear market rally. I don't believe any of it. It's a secular bull market that continues. We're going to be at all-time highs later this year. Could we pull back? Yeah, I mean, anytime you get overbought in any rally, you should be looking for a pullback. And I do want to mention that Monday is option expiration. Well, it's the Monday after option expiration. And historically, since 1950, the Monday after options expiration is the absolute worst day of the calendar month. Doesn't mean it goes down every time. I think the numbers are actually, I think it goes down about 37% of the days since 1950. So I don't know if I said up or down, but it goes up 37% of the days. It goes down 63% of the days. And when you compare that up percentage of 37% to what is normal any particular day of the calendar year, that average is 53%. So you can see it's 16 percentage points less of a chance on the Monday following option expiration that we're going to go higher. The other thing that was interesting is after the close on Friday, the U.S. had its debt downgraded. And as a result, we saw futures after hours on Friday down more than 1%. I think I saw technology, the XLK, was down about 1.4%. So it's quite likely that a lot of the gains that came after Monday, because Monday was really the strongest day this past week, coming out of the more positive tariff discussions with China. After Monday, there really wasn't a whole lot of gains. And in fact, the after hours on Friday pretty much wiped those out. So we'll see what happens on Monday. It doesn't look like we'll get off to a good start, but anything can happen over the weekend. So we'll just see what we wake up to on Monday morning. But just keep in mind, historically, that can be a problem. All right, let's take a look at what is going on, or what went on last week in the market. We had the transport second week in a row. Big jump. Actually, I don't know if it was second week in a row. I'm thinking back to the video I did over at Stock Charts on Wednesday evening, which showed transports was the best performer from the prior Wednesday. So at least for the last 10 days or so, transportation stocks have been the leading group. But for this past week, transports gain 8%. NASDAQ up almost 7%. S&P 500, 5.25%. Mid-cap, the 400 mid-cap up 4.8%. The Russell 2000 small cap up 4.5%, and then the Dow Jones 3.4%. So everywhere you turned, we had pretty solid week. But transport's finally gaining some ground. I got an interesting chart I'll show you on that in just a couple minutes. Moving on to the sectors. For the week, this is exactly what we'd want to see. We got technology up 8%, consumer discretionary up 7.5%, industrials 5.6%, communication services 4.7%. Those are 4 of the 5 aggressive groups. The other one's financials, which is in the 6th spot, gaining 3.4%, almost 3.5%. When you look at the defensive groups, utilities, staples, real estate, healthcare, all at the bottom. They gained, which is nice because we're getting wide participation on this rally, but they were badly lacking or lagging last week, the more aggressive areas of the market. Now, I do want to point out on Friday that flipped. And here you can see on Friday, this is just one day, not for the week, but healthcare, utilities, real estate, and staples, those 4 sectors that were at the bottom in the weekly, right down here, for one day on Friday, actually were up top. And that it was an up day on Friday. So we did see some money rotate back into defense on Friday. Now, again, one day is not a trend. That's not overly concerning in terms of making a long, a big market call for the long term. But short term, yeah, I mean, that is never a good thing when you see the market start running out of gas in some of those aggressive areas and the money starts to rotate into defensive areas leading the market. That could set us up. I mean, that would be something that I would say is maybe a little short-term red flag. And then throw in what happened after hours and with futures, or at least after hours down on Friday. That combination, again, probably doesn't bode well for Monday, but let's wake up and see what we see on Monday. Moving on to the transports. So here's the transportation average, which had been dropping pretty consistently and significantly from the end of November all the way down through the first week of April. Of course, that's when the market bottomed and we started to rally. But a couple of good things have happened here. Actually, a few good things have happened here on the transports. Number one, after the big rally back on, I think that was April 9th. That was the day the NASDAQ, if you recall, it was the second best day in NASDAQ history. And again, that was tariff related. But we got good news, saw the big spike. Transports came up. Notice we put in a higher low, went back up, tried to break out, couldn't. We had a false breakout, came back down, consolidated a little bit more. Then we made the breakout above this 14,000 level, came back, hit the 20-day moving average, which was starting to turn up, and then exploded through the 50-day, through price resistance. And now I'm not sure if we got a bottom, like a reversing head and shoulder. Maybe we pull back, put in a right shoulder. But the next push to the upside, or maybe it just continues this week. Maybe we see some weakness in other areas of the market. Maybe the transports continue to push higher. But either way, whether we push higher now or if we come down, maybe get back to about 14.5 to test that 20-day and then move back to the upside, either one of those scenarios would be very bullish for the transport group. Of course, the bearish outcome would be just to lose all this support and go back down below the moving averages. That would not be a good look at all for the transport group. And when we take a look at the transports, this is going back over the last year. You can see that the transports versus the S&P 500 have been drifting lower since that November timeframe. So relative strength has been horrible, but you got to wonder, is the beginning of May, is this something where we're finally turning back to the upside on a relative basis? My gut feeling says no. And it's probably more than just a gut feeling, but let's stretch this out. This is a 1-year chart. Let's go to the 5-year chart. And you can see that this is something that's been going on for a while. It's been a very steep drop. It continues, even though we've seen some relative strength of late. We're starting to roll back over there again on Friday, it looks like. Go out a little bit further. Let's go to 20 years. Right now, or just recently at the beginning of May, we were at a 20-year relative low on transports versus the S&P 500. So as you start looking at this, and by the way, we topped transports relative to the S&P back at the end of 2014. And remember, it was 2013 that this secular bull market started, and money over the past 12 to 13 years has been rotating into growth. Transports, more economically sensitive, a little bit more value oriented. Some of them, some of these transports pay nice dividends. But that's not the area of the market that has performed well for the last 12 to 13 years. It's been growth stocks that have outperformed. But we've had periods where we've seen value stocks do well. And transports, you can see, especially over these last 2 years, it's just been straight down. Now, what gives us a little bit of hope, we'll go out one more time from 20 years to 50 years. And when you see the 50-year chart, you can see that definitely there are periods of time when the transports outperform the S&P 500. The bad news is that a lot of times most of the strength occurs during secular bear markets. So transports are likely to go down, but they don't go down as much as the S&P 500, and we see the relative strength. So the fact that I believe that we're still in a secular bull market, history tells us that we're likely to remain in a downtrend. Now, maybe we pop for a little bit. Maybe we do get back to 3.0, 3.1, have a nice little run in the transports. But from a big picture perspective, I don't think that we're going to see a massive long-term recovery in the transport group on a relative basis. We'll see. S&P 500, wanted to pull this chart up because at the bottom I've got the 5-day moving average of the equity only put call ratio. And I wanted to point out that the bulls are out in full force right now. We have a 5-day moving average, which has now gone down to 0.48, which when we look over the last year, matches the low, maybe even slightly below the low that we saw back on January 24th of this year. And remember, back then when everything was starting to look really bullish, end of January is when I said, I'm getting out 100% cash, because I had too many signs starting to tell me that the market, not that the market was a guarantee to go lower, it was just that there was a lot of risk in the market. And that's the way I view my signals. I don't view my signals as trying to provide us guarantees that we're going to go up or down. But the question is, do you want to take the risk of whether it goes up or down? And when you start getting a lot of secondary signals that tell us, hey, you got to be careful, and they start beating you over the head, the only thing left is for price action to confirm it, which it did really on, I think it was February 21st, I believe. That was this big red candle. Even wrote about an article about it that day on Stock Charts. You can go check out my blog over at Stock Charts. It's Trading Places with Tom Bowley. But this particular day, what we saw was not just a day where we had a red candle. I mean, went down to the 50-day moving average. Who cares, right? I mean, we test 50-day often in an uptrend. This day was different, though, because we saw money rotating all day long into staples. Staples started off low and then went up all day long. Discretionary stocks started up high. They gapped up and went down all day long. And the difference between the performance of discretionary and staples was among the 10 worst days. That the spread there favored staples, and that difference, that rotation, was among the 10 greatest days of rotation, negative, bearish rotation, since the financial crisis in 2009. So this was one of the 10 worst days of rotation in the last 16 years. And so I wrote an article and I said, this is it. Tops confirmed. How low do we go? In fact, just to kind of done with this, but let me just show you real quick what I'm talking about. Go into my blog and let's go into the archives. We'll go back to February. There it is. February 23rd. The top is confirmed. Now it's just a matter of how low we go. And if you go into that article, you'll see me talking about this right here. Discretionary. Look at it selling off all day long on the 21st. The 20th wasn't much better, by the way. We went down hard in the morning, came back a little bit, and then continued it. Look at the 2-day period here on the XLP after gapping down. Consumer staples all day long for 2 days going up. Discretionary 2 days going down. But this day in particular was the one that was among the 10 worst, 10 most bearish rotation days since 2009. And the other thing about these, every one of those 10 days occurred either in a correction or a bear market, every one of them. So when you go back and we look at, this was right here. We were only down at this point probably 2% from the high, but those days have always been in at least a correction or a bear market. So at least a market that goes down 10%, and 8 of the 9 previous were in bear markets that went down 20%. And guess what we ended up doing the next 6-7 weeks? We went down 20%. So you see those days, you better forget about what you're seeing on CNBC, and you need to take notice, especially after all the warning signs going into that day. It wasn't just that one day where all of a sudden you're bullish and you're like, oh, wow, that was horrible. This was a case where there were a lot of warning signs out there. I was very nervous about the market, was cautioning our members for weeks, probably at least 3 weeks, maybe a little bit longer. I had even talked at the beginning of January at our Market Vision event that I thought that we were looking at some point in 2025 of having a correction, minimum 10% correction. And so it started, a month and a half later, and we had a 20% bear market, 21%. Last thing I want to talk about from last week is gold. So remember, I've talked about gold, and I said gold performs very well when volatility is rising. We want to see that fear rising. That's what drives folks to gold. And then also when the dollar is falling. That's kind of the strategy with gold. You want to be in a market that's declining, S&P 500 generally that's declining, that's under pressure, bad news. And then you also want to see the dollar declining. Look at gold going up. It's been going up for the last year. But when it really started to go up was at the beginning of the year, right here. This is when it really started to move. This is gold relative to the S&P 500. And so the relative strength came after January 13th. What happened on January 13th? The dollar topped. And when the dollar started going down, gold took off on an absolute basis, took off on a relative basis. Then we topped here on a relative basis on April 21st. What happened on April 21st? Oh, the dollar bottomed. And so the dollar started rallying. And that dollar, when it got to 98, I talked about it being a bottom because it hit a trend line. It hit like a 15-year trend line perfectly. So that was kind of the time that the dollar looked like it was ready to rebound. And it has so far, back up to 101, got to almost 102. And during this rally, we've also been seeing the volatility index come down. Fear is subsiding. Dollar's going up. Both of those are bad for gold. So what's gold done? Gold has been falling relative to the S&P 500. And this right here is what I was worried about when we started to regain our secular bull market, which we have over the past month and a half. So gold is still in an uptrend. I'm not saying gold's dead. I'm not saying gold won't go higher. What I'm saying is that I don't believe gold is going to outperform the S&P 500 over time. I think we're going to get one more bounce on gold on a relative basis. And I think it's going to be when we have this next pullback that takes us maybe to the 20-day moving average on the S&P 500. And if the dollar happens to go down with that move, I think that could, because anytime you go down, normally you'll see the VIX go up. So if the VIX goes up and the dollar goes down, we get a pullback in the S&P, I think you'll have one more shot on gold back to the upside, and then we'll see from there. But I believe we're going to break out the all-time highs later, which is not going to be a good thing for those of you holding gold or gold stocks. But that's my opinion. All right, we got a big event. Yesterday we had a huge event. You can search for it on YouTube, or make sure you like our video and you subscribe to our channel, because if you subscribe to our channel and have your notifications on, whenever we start a live stream or post a video onto our YouTube channel, you'll be notified. So you want to make sure you stay up to date on the way we're looking at the market and what we're seeing, trying to help everyone out there. But make sure that you like the video. That helps us, and also subscribe to the channel. It really works, helps us to build our YouTube community with the algorithms at YouTube. So please, even if you can't become a member of EarningsBeats to help us financially, you can still help us by hitting that like button and subscribing to our channel. So we really appreciate that. All right. So we got a big event coming up Monday where we're going to be what I call drafting the 10 stocks, equal weighted stocks that we're going to have in our portfolios, our model portfolio and our aggressive portfolio and income portfolio. And we hold these for 90 days. And our history is just crazy. I'm going to show you the results in just a minute. Before I get into all that, I want to mention, if you go over to EarningsBeats.com, at the top, you will see this flash sale. Because this event tomorrow is so big, all of our quarterly drafts are huge. We want to give a nice flash sale to anyone who wants to come in so they can be part of this. Right here also on, as you scroll down the page, you'll see this flash sale. It expires on Monday, so you got a little bit more than a day to still be able to take advantage of this flash sale and join us. If you click on these, either the top or this link, it will bring you to this page, which you can see right there, claim your offer. But this is 30% off on an annual plan. Typically, our flash sales are 20% off. So this is a really big deal. You're probably not going to see anything like this for a while. So take advantage of it and come join us tomorrow. Now, let me show you what we've done since November 19th, 2018. That's when we began our model portfolio. So what we've done is we've compared the model portfolio with the NASDAQ, you probably are familiar with Kathy Wood and her ARK funds. I mean, billions and billions of dollars are in those ARK funds. So we have the ARK W and the ARK K. We've also got the S&P 500 in here. And if you're an IBD fan, here is your Innovator 50 IBD ETF, the FFTY. So put all these on a chart and you can see the light blue line right here. Look at EarningsBeats. Up, came back down during the latest bear market, but starting to turn back up again. But look at where we are, $100,000 invested back November 19th. As of the beginning of this month, that 100,000 would have grown to 361 based on our picks and our equal weighted picks in our model portfolio, which swamps even the NASDAQ, which has been on fire during this secular bull market. Over the last 6.5 years, our model portfolio has outperformed it by a mile. Same with the ARKW, which is the flagship over at the ARK funds. S&P 500, I mean, that's going from 100,000 to 200,000. That's up, a little over 100%. We're up over 200, we're at 260% versus 108. That's a huge outperformance over a 5.5 year period. And then we've got the ARKK, and then that Nifty, not the Nifty 50, but the IBD, that Innovator 50, which is almost exactly where it was 6.5 years ago. So anyhow, this is kind of why this is such a big deal, why these events are so huge. It's because of our performance. And every one of these quarters are documented with a recording on our website. You can go back and listen to every one of them if you want. We lay out the stocks we want, the reasons why we're picking them. And, I would treat this as an aggressive area. I mean, it's an aggressive portfolio. That's the first thing to consider. Probably even the bigger thing to consider is that we are not registered investment advisors. I'm not advising anyone. We started this back in 2018 just to show folks how you could put together a portfolio and beat the S&P 500. It was clearly for education purposes. We had a strong earnings chart list that had a number of companies on it, probably 200 or 300 companies at the time. And members wrote in and said, we love the strong earnings chart list, but that's a lot of stocks. Can you narrow it down to some of your favorites? And that is when the model portfolio was born. We said, okay, we're going to have an event. We're going to start picking 10 stocks every quarter, equal weighted, and let's see how we do. 6.5 years later, here we are. Again, Monday after the close, I think we start at 5:30 p.m. Eastern, and you can always get the recording. They're all recorded, so you don't have to be there live, but you do need to be a member at EarningsBeats to be part of this. So take advantage of that flash sale. Again, go to EarningsBeats.com, click on the link, claim your offer, and come join us tomorrow night. So what are we going to do tomorrow night? Well, the first thing we're going to do is we're going to look at the strong earnings chart list, because that's where all of our picks come from. Every stock that is in the strong or in the model portfolio came from the strong earnings chart list. My background, I practiced public accounting for 20 years. I think there's a lot to be said about the integrity of management, companies that not only promise to do something, but then deliver results that exceed those promises. That's an important part. And just in valuations, when you are able to beat earnings and revenue estimates, beat the promises that you made because that's what they are. You're basically promising Wall Street that this is what we're going to do. And companies that fall short, especially those that consistently fall short, they're not traded with any kind of a premium. Those are stocks that tend to just kind of go sideways or down most of the time. But when you get stocks that beat, and especially those that consistently beat, you're going to start getting premiums attached to these stocks. When you raise guidance or you beat estimates and companies are forecasting future years' earnings, they start to build that into their models. And then when you take those rising earnings down the road and discount them back to present value, valuations go up, especially in a fairly low interest rate environment. And so that's where the growth comes from in the model portfolio, finding companies that outperform, that are leading stocks. Generally, I try to get them in leading industry groups. That's not always possible, but leading stocks is really important. We want to make sure that we're getting the best within that particular area of the market. And so here is the current strong earnings chart list. And here are, the stocks based on their scooter score, which is the Stock Charts technical rank developed by John Murphy over at Stock Charts. It's a relative strength indicator. It has one glaring weakness, in my opinion, and that is that the formula, if you look at the formula, it's based on the last 5 to 6 months. So you could have a stock that's been going down for 10 years, look almost to zero, and it has a 5 or 6 month rebound. You might see 99.9 on its scooter, even though it's been one of the worst stocks to own for the last 10 years. So it's not a long-term relative strength indicator. It's a short-term. So sometimes some of these stocks, it's a good idea to go from looking at maybe a year chart to maybe go back to looking to a 5 or 10 year chart, just to make sure that these are companies that have, shown some nice solid relative strength over a longer period of time. At least that's one of the things that I like to strive for. So here they are. Right now, I'm going to pull up the edit on here so you can see how many charts are on here. Right now through Friday, because I have updated this, and this will be out available for all of our members. This is one of the chart lists that we prepare. It's like a watch list, and then we allow members of EarningsBeats who are also members at Stock Charts. They can download these chart lists. You don't have to be a member at Stock Charts to be a member of EarningsBeats. You can still see the charts. You just can't download them into a chart list because you don't have the functionality. You're not a member at Stock Charts. You don't have the tools. Anyhow, these 500, 10 of them will be in our model portfolio on Monday. So this narrows the field from many, many thousands of companies down to 500. And then I simply go through, look at relative strength, look for leaders, and put together a portfolio of typically 10 stocks that are in 10 different industry groups, not 10 different sectors. If I think the market's going higher, I don't want utilities. I mean, they're going to lag. If I think the market's going higher, I'm going to want to be in some of the aggressive areas. So it's going to be a little heavier weighted in technology, discretionary, industrials, financials, communication services, and so forth, because that's where most of the growth comes from in a secular bull market. All right, last thing I want to show you, I'm just going to show you quickly, maybe about 10 stocks that are currently on the strong earnings chart list that I'm going to be putting a lot of thought into, possibly including in one or maybe possibly more of our portfolios. So Insulet Corp, Pod, huge earnings report, big gap up, absolutely one that I'm going to be thinking about. Let's go Mercado Libre. Another one that just broke out above the high that was set a few months ago in new high territory. The AD line looks great. You come down, you see relative strength's been building almost a 52-week high. And it's also, by the way, in a very, very strong group, which is specialized consumer services. So you're getting a leading stock in a leading group. And that's a lot of what we try to look for. AXON. AXON Enterprise just making this big breakout. AD line looks great. Relative strength back near the high. And it's in the defense group, which had been strong, kind of taking a little bit of break. Maybe we're moving back up. But as we've been moving down in defense on a relative basis, AXON has actually been moving up. So it's been going up, even though it's been in a group that's been underperforming. That's pretty solid. Next one. Now, this one is one that's kind of a sleeper for me, but I really like the consolidation. This stock went up very, very quickly. It took a big drop, but look at the AD line continuing to move up. That's telling me that there may be some serious accumulation taking place in Garmin while the stock is being, bludgeoned. And on Friday came up and closed at about a 6-week high. So it looks like maybe it might be on its way to fill the gap at least, but I think it could be a lot stronger than that. The stock still maintains pretty good strength among its peers, among the recreational products group. But look at the group itself. The group has been very weak, which has probably dragged the stock down somewhat, but it continues to show relative strength and accumulation. So this is one that might be a sleeper that finds its way into one of our portfolios. Not quite sure. Let me give you two more. ATRO. This is Astronics. First of all, let's go all the way down here. Look at the aerospace group relative to the S&P 500. Since the beginning of the year, aerospace has been one of the strongest groups in the stock universe, at least the US stock universe. ATRO has been one of the best stocks within the group. So you're getting great stock in a great industry group with superb volume trends. Look at this big volume move here. We came back down, filled gap. This went all the way to the bottom of gap support. And then look at this stock just absolutely explode again. Volume coming in. The last two earnings reports have been very strong, very much a lot of accumulation. You can see that again, that AD line is at a high. That's definitely one to look at. And then I'll give you this last one, which is Zscaler. Zscaler, look at this AD line starting to soar. Look at all these tops coming across, holding the stock back around 217, 218. We just took it out and we are absolutely flying here. Very strong volume. It is one of the stronger stocks in software. And look at software exploding these last 6 weeks or so. This is the kind of stuff that we look for because we want, if you want to beat the S&P 500, duh, how about getting stocks that are beating the S&P 500? Seems like one of the best ways to do it to me. Anyhow, that's what I got for today. Appreciate everybody tuning in. Again, come join us tomorrow night. Change the way you look at the market. I trade these stocks, by the way. The model portfolio, I don't just get in and hold. That's not my style. Again, this is what members were asking for, so that's why we provided it. I'm kind of looking at the results, wishing that I had gotten in and followed it for the last 6.5 years. But use that flash sale. Go to our website. You can see again at the top, flash sale right here, flash sale. Click on that. It'll bring you to this page. Claim your offer and join us with one of the best deals we offer. Have a great weekend, everybody. Rest of your weekend. Let's see what happens this week. Happy trading.